Hello, everyone, and welcome to Under the Rug. Today, we're going to be looking at the outlook for the Australian housing market, a very topical issue as we go into 2024. So 2023 was a year of resilience for the Australian property market. Despite 13 interest rate increases in the last 18 months by the Reserve Bank of Australia, property prices are rising again. And this is largely being fueled by record net migration at a time when home building has not been able to keep up with the demand. If we just have a look at this first chart here, the one thing we can see here is that population has soared from the depths of the 2020 COVID lows, whilst at the same time, building completions have been trending lower. So that supply-demand equation has put upward pressure on pricing naturally. There's more people chasing after limited housing stock. And it's a similar story here with building approvals versus population growth. So that's buildings in the pipeline is also trending lower while this population trend is soaring higher. So what we've seen just in terms of the population is we've had an increase of 518,000 people coming to Australia in the 2022-23 financial year, which is well above the average levels of at least the last sort of 15 to 20 years. And unfortunately, it is creating a lot of financial stress for many Aussies who are looking for affordable housing. So we've got this very clear rental crisis that's happening now. Again, it's a shortage of affordable rental properties because of all the migration that's coming into the country. So we clearly don't have enough available housing to accommodate all of the people coming in. And the reason why we've got a downtrend in building completions and approval, it has a lot to do with what's happening with the state of the building industry in the last few years. So we can see that between July 2022 and April of 2023, we've had 1,709 construction companies across the country enter into administration. That's according to ASIC. And the reason why these builders are collapsing, it's a number of factors, but largely as a result of rising inflation and rising interest rates, as well as increased material costs. We've got a shortage in labour, as well as all the supply chain constraints that have resulted and are still lingering from the lockdowns of COVID back in 2020 and 21. But despite all these negative headwinds, so what we've seen is house prices drop quite markedly in 2022. So what we've seen one of the sharpest drops in modern history in housing prices back in 2022, which was as a result of the rising interest rates through that period, and one of the sharpest increase in 2023. So this is known as a V-shaped recovery. And again, a lot of that has to do with the net migration numbers that we're seeing and improved sentiment about the outlook for this migration numbers. So it's clear that cashed up international buyers they're keeping the housing market elevated, but they're also pushing first home buyers out of the market. So we've got a situation where we've got FOMO, which is the fear of missing out. It's obviously taking hold again, and it is pushing prices back to all-time highs across a number of different capital cities around Australia. So if we have a look at this chart here, we can see that we've got markets such as Brisbane, Adelaide, Perth, all breaking out to all-time highs in terms of their property prices. However, Sydney and Melbourne are still below their all-time highs back in 2022. But across the Australian average, Australian housing has started to break through those all-time highs levels. And interestingly, if we break it down, what we can see is that the major capital cities, they fell further in percentage terms relative to regional housing markets. But the capital cities have also led the price upturn in 2023. So clearly buyers are going into the capital cities more so than regional areas. And also the unit markets has actually also outperformed housing in this recent upturn. So in percentage terms, you can see that the unit markets have underperformed housing for most of the last, well, at least since 2019, but they're starting to make a comeback as well. So in terms of the major players in the housing market being the major banks, let's see what they're forecasting for the property market in 2024. So if we can see ANZ here, what they're saying is they're forecasting capital property prices to lift 6%, and they're expecting the biggest gain to be for Brisbane, which is at 9 to 10%, followed by Perth, Sydney, and Melbourne. And Sydney and Melbourne to lift 6 to 7% and 3 to 4% respectively. Commonwealth Bank is expecting capital city prices on average to lift 5%. Brisbane, they're expecting to tip a 6% growth, Melbourne and Perth to follow with a 5% growth, and Sydney with roughly 4%. Adelaide down there at the bottom at 1%. NAB, pretty similar, expecting increases of about 5.4% nationally. Again, they're looking at Brisbane to be the outperformer, followed by Perth, Adelaide, and Melbourne, with Hobart to be the underperformer. And finally, Westpac, they're expecting a 6% increase across the board. Perth penciled in for the highest growth at 10%, followed by Brisbane, Sydney, Adelaide, and Melbourne at 3% at the bottom there. So they're all pretty similar in terms of the national averages. If you look from Commonwealth Bank through to NAB, it's all between sort of 5 to 6% in that range. And we've got to remember the banks do have a vested interest in having a positive outlook for property. Their profits are directly linked to prices going higher. If we do have bad debts and defaults in the mortgage space, that's obviously negative for the bank's profit. So generally, the banks aren't going to go too negative on their forecasts. But yeah, I mean, as far as the outlook for 2024, and particularly over the next 12 to 18 months, values are going to be linked to two major factors, one of them being the supply and demand fundamentals, as we just talked about, and also consumer confidence. And on the subject of supply and demand, the Labor government, look, they have come under a significant pressure to reduce that net migration number to help ease the housing crisis. It's clearly not a good look for the Labor government, especially when their own people are suffering with the housing affordability crisis, to let so many cashed up overseas buyers come in. So as a result of this pressure, the Australian government says it's going to actually reduce the migration intake by 50% within the next 2 years, in line with the pre-pandemic levels. And they're also introducing some tougher visa rules for international students. So there's going to be tests on language, on making sure that there's a reasonable English hold of the English language. But however, with home builders struggling with higher interest rates, it's unlikely that we're going to see enough housing stock being created to meet demand. So in all likelihood, there's going to be a shortage of housing. This is going to continue to be a positive factor for housing prices in 2024, provided interest rates don't rise sharply this year. And this ties into consumer confidence. So if we have a look at the consumer sentiment chart here provided by ANZ Roy Morgan charts. So what we can see, there's been a big drop in consumer sentiment between the years of 2022 and 23, and that's largely as a result of the interest rate increases that we've seen. So interest rates clearly do have a significant impact on consumer sentiment. And the truth is, people generally won't make big financial decisions like moving home or buying a new property unless they feel confident about the stability of the economy and their job in particular. So that's why the direction of interest rates is so important. It's critical when it comes to the outlook for consumer sentiment. And when it comes to interest rates, as I've been saying in recent commentary, the markets generally are expecting interest rates to start falling again in 2024. And this is on the view that inflation is going to continue to ease going forward. So if we have a look at the recent speeches from the Fed Reserve Governor, Jerome Powell, he quickly came out late last year and was talking about possibly seeing interest rate cuts as early as March or April this year. And I think a lot of that has come on the back of the rising bond yields, which is putting a lot of pressure on businesses and individuals across the United States. So as far as the outlook for inflation goes, as I've also been talking about, if we do see a continued escalation of military conflict in the Middle East and further supply chain disruptions on the Red Sea as a result of the Houthis there attacking Western vessels, commercial shipping. So this is going to very quickly put a dampener on those expectations for inflation to continue lower and for interest rates to be cut in 2024. In my opinion, we're going to see higher oil prices in 2024 as these geopolitical conflicts increase. The one thing the markets really aren't factoring in is a possibility of the Ukraine-Russia tensions to increase. They're also not putting much weight when it comes to the China-Taiwan tensions there and the possibility of China invading the Taiwanese. So again, all of this is very inflationary, and this is going to put upward pressure on inflation numbers. And if this does transpire the way I believe it will, it's going to force the Reserve Bank of Australia to keep interest rates higher for longer. And really, when you think about the credibility of the Reserve Bank, I mean, this is the same institution that was saying that interest rates would not be increased until 2024 back in 2017 and 18. You know, as far as what the outlook for interest rates are, we shouldn't really be listening to what central banks are saying anyway. The markets are going to dictate where interest rates are going to go. So if we have a look at Treasury bond yields, and again, I'm going to look at this again as I did in the previous interview. If we have a look at the deflationary trend of the last sort of 40 years, from 1980 to 2020, we've had declining interest rates. This is a deflationary trend that we've been in. And I believe this trend is over. This has clearly been broken, this long-term downtrend in interest rates. And I believe we're going to see a continuation of the stagflationary environment that we're currently in. So stagflation being stagnant economic growth coupled with rising cost of living pressure, similar to what we saw in the 1970s. And the US government is currently running a $2 trillion annual deficit. And it needs to fund all of that spending, that deficit spending, by issuing treasury bonds. And the only way they're going to be able to attract international buyers of these bonds is if they attract a high enough interest rate. So it's going to be very difficult for the central bank to drop interest rates, because if those yields start to go down significantly like they were back in 2020 and 21, it's just not going to be very attractive to buy government bonds at those kind of yields. So if we are in a higher for longer interest rate environment, and the 10-year bond yields in the United States are critical, because up to about 40% of all the money that the banks lend here in Australia, it comes from those overseas markets. So this is the benchmark for all interest rates globally. So if we are in this higher for longer interest rate environment, naturally we're going to see more houses come onto the market as people are being forced to sell. You know, as they no longer can afford their mortgages and the mortgage repayments. So if we have a look at mortgage stress levels, we can see that the number of Australians at risk of mortgage stress, it's increased by 707,000 people since May of 2022, when the RBA began a cycle of interest rate increases. And the number of mortgage holders considered extremely at risk is now numbered at around close to 1,967,000 people, which is significantly above the long-term average over the last 10 years. So we can see here from this chart here that the number of mortgage stress, people considered it at risk of mortgage stress, is at the highest level since around 2007, 2008, which was our global financial crisis, the last major event in the global markets. And again, people at significant or extreme risk of losing their houses is also at some of the highest levels in the last 15 odd years. But this is where interest rates are going to be key. If they do continue higher, we're going to see a rise in unemployment, which is only going to dampen demand for housing and increase mortgage stress materially from these current elevated levels. If we have a look at some of the recent data on employment, so this is a chart of SEEK employment data. What we can see is it's showing labour demand has fallen significantly. That's that red line from the highs of back in 2021, 22. And at the same time, we've got labour supply is growing at a very rapid rate, which is a reflection of all that overseas migration, people coming into the country and looking for work straight away. But furthermore, if you have a look at the number of applicants for jobs advertised with SEEK, so that's also soared, this black line here, and it's well above pre-pandemic levels. However, the unemployment rate is still at these historically low levels. You can see there's a very close correlation between the ratio or the number of applicants per job advertised and the unemployment rate. So if this relationship holds true, then the trend for unemployment is to be higher over the coming years as those job search numbers continues. So this combination is a perfect recipe for higher unemployment. And again, higher unemployment is going to lead to dampening of consumer sentiment. Less people applying for jobs means there's going to be less demand for housing, and less demand for housing is obviously going to weigh on housing prices, and it's also going to tip the scales of that supply and demand balance back into the favor of increased supply. So in summary, the resilience of the Australian property market is going to be tested in 2024. If we can avoid escalation in the global conflict overseas in the Middle East, if we can avoid rising inflation and rising interest rates, this is going to be the Goldilocks type of environment for property to continue to increase in 2024. And if you have a look at most of the mainstream views on property going forward, it is this Goldilocks type of environment where we're going to see benign inflation, we're going to see lower interest rates, we're going to see escalation or de-escalation in global conflict. I mean, these are all possible, but everything that we see at the moment points towards the reverse of that. If anything, we are seeing escalation in conflict. So as I said before, 2024 is shaping up to be a pivotal year for financial markets, including Aussie property. And yeah, so I mean, a lot of people are going to be making some hard choices in 2024, whether to bite the bullet and take that fear of missing out sentiment. Some people are going to hold off and they're going to wait for more properties to come onto the market. So again, it's going to be very interesting to see how all this plays out. But if you are interested in getting advice, feel free to private message me. And again, none of this is personal advice. We do need to look at your full circumstances, your full financial situation before we can actually provide any personal advice that's tailored to your situation. But hopefully this content is interesting. And if you do like to see more, please like and subscribe. And yeah, look forward to putting something out very shortly. So yeah, thank you again for your time and we'll talk soon. Bye.